Welcome to Purpose-Driven Life, where dreams meet reality. Whether you're a homeowner, real estate investor, or simply curious about the economy's impact on the housing market, we are here to help. We hope our videos will help you to gain insight that can help you make informed decisions and navigate the current economic landscape with confidence. We're your gateway to exceptional real estate. Dive into this journey with us, stay informed, discover the truth, and let's debunk the myths together. This is where your new chapter begins.
Hi everybody, welcome to Purpose-Driven Life. This is Serdar. Federal Reserve announced last Friday that they will keep the federal funds rates steady for 2023. Furthermore, they announced that there may be further cuts coming. They said three more cuts could happen depending on how everything is moving in 2024. Changes to federal fund rates often have a big, if indirect, impact on mortgage rates. That's why if you have a mortgage or are planning to get one, it's a good idea to know what the Federal Reserve does. Though it can be a bit of a boring topic, of course, Fed policy decisions have a lot of real-life implications for everyday people, especially current and future homeowners. In today's episode, we will explain how those two things impacts the homeowners and the people who are actually planning to become a homeowner.
Have you ever contemplated how the Federal Reserve influences mortgage rates? The underpinning association between these two entities is not a simple one. It's a complex web of reactions and counter-reactions, a delicate dance that plays out behind the scenes of our financial lives. It's a relationship that has direct and indirect implications on our economy, affecting not only the housing market, but also the broader economic landscape. The Federal Reserve, in its capacity as the country's central bank, has the power to adjust key interest rates. These adjustments, in turn, impact the rates that banks charge for mortgages. This intricate relationship plays a crucial role in the ebb and flow of the economy, and today we're going to untangle it. Imagine the economy as a colossal ship, with the Federal Reserve or the Fed as its captain. This immense vessel sails through the vast sea of trade and commerce. The Fed, like a seasoned captain, guides it through economic uncertainties. Its helm, the federal funds rate, is the instrument that helps navigate. This rate is the interest percentage that banks levy on each other for overnight loans. By expertly adjusting this, the Fed ascertains smooth navigation. It keeps our economic ship sailing steadily, striving for price stability and low unemployment. To achieve this, it adjusts the federal funds rate, which is the interest rate banks charge each other for overnight loans. Now, let's put the spotlight on mortgage rates. Mortgage rates are a complex matter, impacted by various factors. One would assume they're linked to the federal funds rate, but that's not the case. They're much more influenced by elements like the 10-year Treasury yields and investor demand. A critical part to understand is the 10-year Treasury yield. This yield is essentially the return on investment for a unique category of government debt security, one with a maturity period of 10 years. When the economy is heating up, the Fed raises the federal funds rate to combat inflation. This increase often influences the 10-year Treasury yield, consequently pushing mortgage rates higher. Conversely, during economic downturns, the Fed slashes the federal funds rate in order to kickstart expansion. Decision usually brings down the 10-year Treasury yield, in turn causing mortgage rates to drop. On the other hand, when the economy is slowing down, the Fed reduces the federal funds rate to stimulate growth. This move typically decreases the 10-year Treasury yield, leading to lower mortgage rates. Inflation and economic conditions greatly influence mortgage rates. High inflation results in soaring mortgage rates because investors require amplified returns to counterbalance the dwindling purchasing power. When the economy dips into a recession, a different scene unfolds. Investors gravitate towards the security offered by U.S. government bonds. This causes an upsurge in the demand for these bonds, subsequently pushing down their yield. As a result, mortgage rates experience a downward trend. Conversely, during a recession, mortgage rates tend to drop as investors flock to the safety of U.S. government bonds, which pushes down the yield and, in turn, the mortgage rates. Remember that personal mortgage rates depend on an individual's unique financial profile. These rates aren't arbitrarily determined. They are connected to a person's unique financial situation and credit status. The larger rate trends, which may seem abstract, are influenced by various economic conditions. These include inflation, unemployment rates, and fluctuations within the housing market. However, These macroeconomic factors only set the framework. Your specific rate may vary based on your financial standing and creditworthiness. In summary, the Federal Reserve influences mortgage rates indirectly by managing the federal funds rate and the larger economy. This intricate interplay involves meticulous calculations to ensure stability. It's wise for homeowners and buyers to keep abreast of interest rates and Fed policy shifts to discern the best times to secure a mortgage rate. The link between the Fed's actions and your mortgage rate may not be direct, but it's significant. Keep in mind, fixed-rate mortgages offer a stable rate, while adjustable-rate mortgages fluctuate based on market rates. This knowledge can assist you in navigating the complex realm of home buying. So, next time you hear about the Fed adjusting the federal funds rate, you'll comprehend the potential domino effect it may trigger on your mortgage rate. This insight can be instrumental in shaping your home buying choices.